Hello, my name is Clay Hostetter and I am the Tax Planning Manager at Raymond Gurrell Wealth Management. I'm also a CPA, Certified Financial Planner, and Certified Investment Management Analyst. Today we are going to discuss the new tax code changes in effect for 2026. If you or someone you know could benefit from any of the services our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to identify opportunities for optimization in investments, tax planning, estate planning, employer benefits, and retirement strategies. Without further ado, let's dive into today's topic, the new tax landscape for 2026. 2025 was a landmark year for tax policy. The One Big Beautiful Bill Act, or OBBBA, was signed into law and made many of the temporary Tax Cuts and Jobs Act provisions permanent. Lower individual tax brackets, a higher standard deduction, and an elevated estate and gift tax exemption are now part of the long-term landscape, rather than items scheduled to disappear at the end of 2025. On top of that, the IRS released its usual cost of living adjustments for 2026 with a 2.8% inflation adjustment. That flows through to income tax brackets, standard deductions, retirement plan limits, health savings accounts, and more. From a planning standpoint, this means that our conversations are shifting away from what happens when TCJA sunsets and toward how do we make the most of a beneficial tax regime that is likely to be with us for a while? Tax strategies like Roth conversions, bracket management, charitable giving design, and multi-year gifting continue to be central tools, not just short-term maneuvers. Next, let's look where the federal income tax brackets land for 2026. The 2026 federal tax brackets maintain the same structure we've had for years, including the 37% top tax rate. The main update is that all of the bracket thresholds are moving higher, reflecting inflation. For most taxpayers, that simply means that each bracket is a little wider. This can create slightly more flexibility for Roth conversions, realizing capital gains, or adjusting income in retirement without jumping into new tax brackets. We won't go line by line through these charts, but these updated thresholds set the stage for the rest of 2026 planning. Now let's turn to the standard deduction. For 2026, the standard deduction increases again. This increase brings the standard deduction for married couples to $32,200, $16,100 for single filers or married filing separate, and $24,150 for those who are filing head of household. Taxpayers age 65 or older continue to receive the traditional additional standard deduction, and beginning in 2026, there's also the new senior deduction of up to $6,000 per eligible taxpayer, which phases out at higher income levels. Another notable change, taxpayers who claim the standard deduction can now take a separate charitable deduction, which is $1,000 per person or $2,000 for joint filers, and is subject to a 0.5% AGI floor. In practice, this creates a bit more flexibility for charitably inclined taxpayers who do not itemize. Strategic deduction lumping of charitable gifts, property taxes, and medical expenses is still a viable strategy, but the bar for itemizing remains relatively high. Saving for retirement through tax-advantaged accounts remains one of the most powerful planning levers, and the limits increase again in 2026. For 401ks, 403bs, 457s, and thrift savings plans, the employee contribution limit increases to $24,500, up from $23,500 in 2025. The catch-up contribution for those who are ages 50 and older rises to $8,000, That means that anyone 50 or older can defer up to $32,500 of salary into these plans in 2026, before even counting any employer contributions. Those aged 60 to 63 retain access to an enhanced catch-up of $11,250 where plans allow for it. The maximum total contribution to a defined contribution plan, including both the employee and the employer dollars, increases to $72,000. For defined benefit plans such as pensions, the maximum annual covered compensation rises to $290,000. The compensation limit for defined contribution plans increases to $360,000 for eligible pay, up from $350,000 in 2025. These moving pieces matter for high earners, executives, and anyone using strategies like mega backdoor Roth conversions or non-qualified deferred compensation plans, because they define the ceiling of how much can be sheltered in tax-advantaged accounts each year. One change that will be especially relevant for many corporate professionals is the Roth Catch-Up requirement. Starting in 2026, if you are age 50 or older and your prior year wages exceed $145,000 from the same employer, any catch-up contribution must be made to a Roth account. Your base deferral can still be pre-tax or Roth. Only the catch-up dollars are required to go to the Roth account. Employers have until the end of 2026 to implement this change, so you may not see the change happen immediately. This rule shifts more retirement savings into Roth accounts for higher earners, which can be beneficial in the long run, but does reduce some flexibility. Next, let's look at individual retirement accounts. For both traditional and Roth IRAs, the annual contribution limit increases to $7,500 per person in 2026. The catch-up contribution for individuals age 50 and older increases to $1,100. There are also updated income thresholds for both traditional and Roth IRAs in 2026. Traditional IRA deduction limits increase for taxpayers covered by a workplace plan. The Roth IRA income ranges also move higher. In general, single filers and married couples can contribute or deduct at higher income levels than in 2025, but phase-outs still apply as income rises. These thresholds are critical for deciding whether you can use a direct Roth contribution, need to look at backdoor Roth IRA strategies, or should consider other savings vehicles altogether. Health savings accounts continue to be one of the most tax-efficient tools in the code, offering a deduction on the way in, tax-deferred growth, and tax-free withdrawals for qualified medical expenses. For 2026, the HSA contribution limit for self-only coverage rises to $4,400, and the limit for family coverage increases to $8,750. The catch-up contribution for those age 55 and older remains $1,000. To be eligible, you must be covered by a high deductible health plan that meets the updated 2026 requirements. High deductible health plan requirements also increased modestly. For 2026, an HSA qualified HDHP must have at least a $1,700 deductible for self-only coverage and $3,400 for family coverage, with updated out-of-pocket maximums. The OBBBA also modestly expands what counts as a qualified medical expense in certain situations, including some direct primary care arrangements and telehealth services. For families with ongoing healthcare costs, these details can make HSAs even more attractive as a part of a long-term saving and retirement healthcare strategy. Now let's shift to gifting and estate planning. The annual gift tax exclusion remains at $19,000 per recipient for both 2025 and 2026. That means that a married couple can give $38,000 per year to any one individual without using any of their lifetime estate and gift tax exemption, and without filing a gift tax return. The federal estate and lifetime gift tax exemption itself increases to $15 million per person in 2026, up from roughly $14 million in 2025. Portability continues to allow many married couples to effectively protect significantly more than $15 million from federal estate and gift taxes. If your net worth is approaching or above these levels, it becomes increasingly important to coordinate your investment, tax, and estate strategies. That might include lifetime gifting, trusts, charitable strategies, or other tools tailored to your goals and your family dynamics. There are a few other adjustments that are especially relevant for high-income earners or globally mobile taxpayers. For Americans working abroad, the foreign earned income exclusion increases to $132,900 of eligible income in 2026. This is up from $130,000 in 2025. Finally, the Social Security wage base rises again. In 2026, up to $184,500 of earnings are subject to Social Security and payroll taxes, compared to $176,100 in 2025. That change can affect both current cash flow and long-term Social Security benefit projections. At Raymond Gurrell Wealth Management, we have over $1 billion in assets under management. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specialize in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life both before and after retirement. If you would like help evaluating your 2026 tax planning opportunities, we invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.